Ajay Bagga now joins us live. Ajay, good morning. Thank you so much for joining us this morning. Could you just tell us what's happening in the market? We just spoke to Saurabh Mukherjee from Ambit, and he says that fund flows can actually continue from FIIs to be on the negative side for really some time.
Yeah, that is anybody's guess, Pankaj. If you look at the last 3 months, we have seen net outflows and pretty significant ones. The good thing is that there have been inflows from the DIIs which have countered this quite strongly. And hopefully now, as this FII outflows abate over time, we should see some growth in the market with the DII inflows continuing. Now, will FIs continue to take money out of India? That's anybody's guess. There is a huge market rotation on where money is going out from emerging markets into DMs, largely into US and Japan. Japan is the most favored market right now on the back of a very depreciated yen and expectation of a further depreciation in the yen. And the BOJ commentary also yesterday talked about better economic growth. So Japan is looking like the top performing market for 2017, attracting some flows and a lot of flows going back into the US markets. And we are seeing outflows from emerging markets, but within emerging markets, we have got hurt by the news flow on the demonetization and the earnings degrowth that it has brought in. I think as that settles down in next quarter, you could see at least the FIs out abating, if not reversing. So anybody's guess, Pankaj, it's made up of a lot of people, right from pension funds who have 20, 30-year horizons to hot money, which is leverage money and takes intraday positions. So FIs themselves are a very heterogeneous group. Very tough to really take a call that these outflows will continue.
Right. What do you, make of the DII flows? So far, domestic retail, domestic funds, fund flows have been pretty good. But if the returns were not to be that great, say in the next 6 months, do you see chances of redemption coming in and that could put further pressure on the market?
Yeah, that is very much a possibility. And historically, what has happened that inflows have peaked at the peaks of the market, and then as the markets have corrected, we have seen outflows. This time, the flows have been a little counter-cyclical, whereby, especially in November, we saw nearly 13,000 crores coming in. So hopefully, the huge SIP. Where nearly 1 crores of SIPs are now there, which are contributing roughly 4,000 crores month on month into the equity mutual funds, and then you add on the insurance inflows. I think those two hopefully will hold up the market is our best forecast. Non-performance, yes. If you look at from March 2015 to now, the market has gone nowhere. In fact, we are 1,000 points off from the March peak of 2015. So time-wise, the market has not really returned. But active alpha generation has been there by the funds who have given some kind of returns. And SIP-based people have made money because they've been putting more whenever the markets are down in terms of dollar cost averaging. So DII flows, the forecast is that right now they continue, especially next month's tax swing. ELSs normally attract about to 10,000 crores of inflows in this Jan to March quarter. That should hold up the markets to some extent.
Right. But, do you think right now it's very tricky to, go ahead and predict what will happen in FY18, whether earnings will recover, it will not, or, we'll have to get the data till March and then probably try and predict what will be the pickup, what is the management commentary, and then only big flows can come into India?
Yeah, very big possibility, Pankaj. And if you look at the sell side guys, their records are not very good anyways. Last 3 years, the November forecasts have been way off and very extra optimistic, and that kind of growth has not come in. So the market has enough skepticism built in on earnings growth. I think the big catalyst will be first the PM's Lucknow rally on January 2nd. Does he bring in any sops or talk about any tax concessions to the segments which have got hurt? Then the build up to the budget. So as Parliament starts on January 16th with the budget session, you could see some kind of a budget, pre-budget rally coming into the market. So in anticipation of that, will positions be taken next week or in the first week of January? Anybody's guess, but I think yes. I think the selling is really overdone. It is an oversold market even technically. It is seeing a strong support at these 8,000, 8,050 levels. It's not really cracked through that. The FI selling also, if you see, has been moderate. It's not been those huge sell-offs that we used to see in earlier market downturns. They are doing a very calibrated sell-off. Now, is that a slow pain which will continue for months on end, as Saurabh was saying? I don't really know. Very tough to call. Normally, if you are doing a rotation out of a market, you would try to sell out as early as you can to avoid the impact cost really becoming very big as you become the last few guys standing in the market. So very tough to call that. But I would say the domestic triggers will be budget session, the pre-budget anticipation. The government, does it come out with structural reforms now, give some tax concessions now that a lot of the pain has been taken by the industry? Then 16% of banking loans are SME, 24% are farm-based. Both those sectors are suffering on the back of demonetization. Any SOPs that come out here, any SOPs to traders, to the middle class, which has suffered a lot in the demonetization. I think those will be key factors to look at. GST, to my mind, is looking like a July 1st or a September 1st at the best scenario. Otherwise, the government loses its right to tax anyways if it's not passed by September 1. So I think there will be a scramble between July to September to get it passed. Before that, we'll have the UP election result. That will have a big bearing on the overall sentiment and overall how the foreign investors are going to view this government, what it will do in its 2 years of term.
So, Mr. Bagga, how are you tactically placed for this period? A lot of triggers for the markets. What would you look at if you want to buy something? How are you tactically playing this, the news developments of the future? Yeah, the first thing is cash is king as always. So no hurry in buying. It could be a slow drawdown if the FIs continue selling 500-600 crores a day as has been the pattern over the last 30-40 working days. So no hurry. Second is watch out for any of these announcements because then the market gets a leg up. Third would be the earnings season. If it is not as bad as the market is discounting in, and if the management commentaries are better between Jan 15th to Feb 15th, then the market gets a leg up. And the fourth very big one will be the opinion polls on the UP elections. 3 municipalities, the BJP has done very well, Gujarat, Maharashtra, and yesterday in Chandigarh. Again, cannot make a trend out of that, but seems like there is a lot of support coming for demonetization. It's been very painful. It's hurt the earnings. It's hurt the economic growth trajectory, but seems to have a lot of popular support. And pundits are normally wrong in reading that popular support. So if that is coming through, and if UP, the opinion polls show the BJP gaining, then these markets could really take off. So there is some political linkage into the markets. But
There must be something that, cash is king, but there must be something you would perhaps look to buy in anticipation so that you may gain from that move. Anything that you've identified?
Yeah. Yeah, I think banks again have gone down. You can look at private sector banks. I would not touch most of the public sector banks yet because of the GPA issues which are still very clouded. So private sector banks you can look at. NBFCs I would still give a miss. I think there's some more correction happening. Pharma again, too much of regulatory overhang on FDA and the antitrust case in the US. I don't know how big that will become. IT on a counterintuitive contrarian bet. I think IT selling was overdone. The Trump effect will not be so strong. One, the companies cannot bring back outsourcing. It's just not possible, not feasible. The kind of talent they get for the kind of money that they pay is not available within the US. So one, the outsourcing is pretty much oversold and it's been taken a very pessimistic outlook. Second is the H-1B visa. That workforce is not there in the US locally, that skilled kind of a workforce at that cost. So yes, if the cost has to be brought up or more of work is pulled back out of the US, or third, you hire locals for that, which is going to be very high cost, that will have a 200 basis point impact on the margins for that work. And that's what the market has factored in already. Any news on that this is it or it's not worse than this, will see the IT stocks rally. Also the strong dollar will help them. So overall IT I would be positive. Cement is getting hurt a lot and now the fuel input costs also going up. So cement has got battered. That will see a pickup in the next 3 to 4 months. I think cement can be looked at. And then more than that, I would be very stock specific, be very careful. I think more pain than gain in this market. We've had a very big interruption to the growth trajectory and that will take a bit of a time, maybe 2 months at the best and maybe 6 months at the worst case scenario.
Right. So can you name some stocks, since you said you have to be very specific of the stocks that you buy? Can you name some that look relatively better than the others?
Yeah, stocks unfortunately, because of SEBI compliances, I don't talk about. But sector-wise, as I said, private sector banks go for the growth as the economy rebounds. These will be the first beneficiaries. Then I would look at IT, both mid-cap IT as well as large IT. I think that is overdone, the correction there. We have already seen some kind of gains coming in the last few days. That will accelerate. Cement, I would go more with the large cap cement, the national level players with the largest capacities. I think the top 4 or 5 can be looked at. Then auto, I think the demand comes back quite strongly. So wait for the dip post the Jan 15th earnings. Around that time could be a good time to get back into auto, more in the passenger vehicle and the two-wheeler space. I think that recovery will be V-shaped. And based on that, auto ancillaries as well, which are servicing either the US market, I think we have quite a few there, or which are more domestically oriented. Those will also see a V-shaped recovery in the second quarter. So Jan 15th onwards could be a good time to nibble at auto and auto ancillaries also.
Right. As far as the overall mid-cap, small-cap space is concerned, last 2 years, at least in about since the taper tantrum, they've given great returns. Do you believe that now it will become very selective in the mid-cap, small-cap space and only stocks which deliver earnings or which have chances of better growth would tend to do well?
Yeah, Pankaj, I wish that was so. What happens in mid-cap is the impact costs are quite high. So especially what we call euphemistically the operator-driven stocks, which are junk, but which stories get circulated or which get manipulated up. by various sections. Very difficult to control those, especially in the micro cap, small cap segments. Very little money can move those stocks. So it really doesn't play out that well, Pankaj. Yes, when they fall, they really crash through. We have seen enough of those stories in the last 20 years. But overall, what we really tell customers is, one, if you are starting off in the stock markets, it's good to go through the mutual fund route, especially for micro cap and mid caps, because the fund manager is doing all the heavy lifting for you. Second, if you really want to caps, so look at a top-down story. That will help you. Bottom-up is very difficult for a lay investor to go meet the managements, figure out the honesty, the credibility of the managements of the business model, look at the cash flows, becomes a little difficult. And third, stick to the knitting, what you know best. So there are a lot of very good mid-cap stories as well of decent managements, emerging mid-caps. Look at the top-down sector. Cement, for example, I remain convinced it's been battered down. It will see some more hurt coming in, but it will come through. So mid-cap cement, mid-cap IT, which will really benefit. Then you're going to see a lot of defense orders coming on the back of the budget. There will be a run-up there. So those could be also one positioning you can take now. Be ready with the mid-cap defense sector and take positions, and then sell off post the budget if you're a short-term trader. I think those could be some of the themes. NBFCs would be attractive normally, but right now the political risk has increased, especially on the MFI segment. On the other segments, the loan against property is going to hurt. The liquidity hurt in the economy. And a lot of business models will have to go organized or will have to go down. Now, who pays the cost of businesses going down becomes a very big issue. 35 million companies and LLPs registered in India. How many of them will really survive this change in business model, where the businesses were totally cash-based, and now it will become increasingly difficult. So the banks and NBFCs will pay a big cost for those models going out of fashion. Either they will become organized or they'll go out. So have to be careful. Pharma, I would say, stay away from because 35 plus FDA actions already, more will come, and the antitrust case which has come in, if that spreads, that can be quite debilitating for Indian pharma. So pharma, I would not really touch. Let it go down more. Let some semblance of normalcy return. It's been quite sad that they've not spent on consultants to manage this FDA issue, to ensure that their quality controls are in place. And that also shows that the Indian regulators have been sleeping on the steering wheel in pulling up these companies. It's quite unfortunate, and the investors have to pay that price. But that's the reality, so stay away from the sector.
What do you do with something which is a great brand? Just taking an example of Asian Paints, or maybe the sector leader in one of the best sectors that you would want to own within the consumer pack. It gets impacted by what's happening with demonetization, and also because of commodity prices which have really not corrected. It has an impact on the margins as well. Just stay away from these names because margins could take a dent, volumes could take a dent, which means there could be huge cuts on the EBITDA estimates.
Yeah, I think paints, durables, all the cable companies, switches, all the companies which are suppliers into the residential real estate market, that will take time. And there, again, I'm saying cement might be a better way to play because cement is more broad-based. If infra takes off, if the government gives a big push to roads, ports, infra building in the budget, these cement majors will rally first. Even though the coal prices are up, their input costs are up. So margins will be impacted, but they have a lot of spare capacity. So with very little capex and just on marginal costing basis, they'll be able to ramp up volumes as volumes come back. So I would stay away from the durables and the suppliers into the residential real estate market, at least for the next 3 months till we get some clarity. If some tax sops come in for affordable housing, if those kind of things come in, then the sector takes off. So wait for that, or wait in anticipation of that, maybe another 20 days. If there is some street buzz of those kind of things coming, then you could take some position in that. Otherwise, wait off, and 3 months later, you'll probably get them at the similar prices.